So, you've made some great choices so far. You want to buy and hold for the long term, you want a platform that'll give you low fees, and you want a global ETF so you can have a piece of all the action. Pretty smart so far. But when you're scrolling through Vanguard's fund options, there seem to be several that do exactly the same thing. You're a bit unsure and want to understand the differences. It's frustrating as you're so close, but yet so far from starting your investing journey. Well, don't fear, we've got you covered. As a cheeky bonus, in this video I'll show you how to recreate these funds on Vanguard to get an even lower fee. So what is the best ETF that Vanguard has to offer? Let's start by clarifying something straight out the gate. There is no single best ETF.
Why you always lying?
You can only view this from a historical standpoint, and past performance isn't an indicator of how it will perform in the future. The best thing you can do is matching your investment needs to a product that's being offered. So let's look at the three most popular global ETFs that you'll find on Vanguard and that you'll have seen spoken about many times online. Those three are the Life Strategy 100, the FTSE All World ETF, and the FTSE Global All Cap. These three are spoken about most often for a good reason. They're all great products. Let's have a look at what they have to offer, but most importantly, how are they different? Before we get into the video, if you have an interest in investing, finance or income growth, then please consider subscribing to my channel. It really supports small channels like mine. Before we start comparing, I do need to raise a conflict of interest. I am mainly invested into the FTSE All World ETF, ticker symbol VWRL, and I have been for about the last 3 years, so I just want to flag my biases now. Let's get into the comparison. So where should we start? Costs. The vast majority of us are aware that Vanguard are famous for two things: having a low cost structure and also driving costs even lower when they can. As a quick example, in the last 18 months, they've actually moved my fees down from 0.25% to 0.22%. If we take a look at all three, the costs are nearly identical. Both the Life Strategy 100 and the FTSE All World are at 0.22%. This means the FTSE Global All Cap is highest by only 0.01%, which in all fairness is very little, but then again, if you can get away without paying it, then why not? For me, this is very much a point for Life Strategy 100 and the FTSE All World ETF, but there's nothing too hideous if the FTSE Global All Cap is the one for you. Next, we're going to look at weightings. This is probably the most important part of your decision making process, as this really separates one from the other two. So how are each funds weighted? Weightings are how balanced each fund is across the relevant sectors and geographies. To spare you endless detail, I think it will be helpful to focus on just two key regions which are probably most critical to you as an investor. These would be what portion of the fund is exposed to the UK. I am going to make the assumption that most of you are based in the UK, but if not, then it's no biggie, it is still relevant to you. And secondly, what portion of the fund is exposed to the US? Why the US, you ask? Well, consider the US as a combined stock exchange market cap of 37 trillion. Which, in fairness, is hard to compare unless you know the size of the second biggest geography, which is Japan, which has a combined stock exchange market cap of only 9 trillion. So how does each of these three funds size up against each other when looking at the exposure of the US and the UK? Let's get the two out of the way which are virtually identical. The FTSE All World and the FTSE Global All Cap both have around about a 4% exposure to the UK and around a 58% exposure to the US. This reflects how big each region is in the world's economy. But what does this mean for Life Strategy 100? Life Strategy 100 is the black sheep of the family, as it has an exposure of a whopping 21% in the UK and 40% in the US. That's not to say it's a bad thing. Weightings are a very personal preference, and if you're putting your money into a global ETF, then you need to be clear that the fund is overly exposed to the UK versus how the world's economy really looks like. This actually does have an advantage, which I'll come back to later. But if you're buying into Life Strategy 100, then you should have a bullish view on the UK in the terms that the UK will outperform the world, or at least keep pace with it in the future. Now let's look at dividends. There's not a lot of things sweeter than waking up one morning to see companies knocking at your door trying to give you boatloads of cash. Let's see how each of the magic three stack up against each other. As you can see, these range from about 1.4 to 2%, with Life Strategy being the highest and the FTSE Global All Cap being the lowest. There's no massive difference, but there might be difference enough to change your decision on which one you go for. It would be naive to score these funds based on their dividend levels, as it's not the whole story. If we were looking for something that was a high dividend payer, then we wouldn't be looking at these three in the first place. So let's overlay that with the historical performance. Data does vary between each fund, so what I'll have to do is I'll use a 5-year actual performance, and where this isn't available, I'll use a 5-year benchmark performance. Again, we have a range from between 80% to 98%, with the FTSE Global All Cap on top and the Life Strategy 100 being in last. This actually shows an inverse relationship between each of the funds in relation to the dividend levels and growth levels. The FTSE Global All Cap has the highest growth rate historically, but has the lowest dividend, but then Life Strategy 100 has the lowest growth, but then the highest dividend. Historic performance isn't an indicator of how it will perform in the future, so scoring against this wouldn't be appropriate. Let's have a look at the minimum requirements for setting up an account for each of these funds. If we're going to start on our investment journey, then the minimum requirements could be critical. You want to get started now, not to wait up to save up thousands of pounds to get the ball rolling. Well, let's take a look. A bit boring this one, as each of them have the same requirement, either an initial lump sum of £500 or a regular deposit of £100. This is more props to Vanguard than anything else, as £100 to put in these products without any sort of entry or exit fee is incredible. The last piece of information you need is if these funds are hedged or unhedged, but let me clarify by what I mean. If your fund is hedged, then this is where you're protecting yourself from the movements of currency, but in our case all these 3 funds we're looking at are unhedged. This means if sterling was to weaken, when the profits are being converted from foreign currencies, we'd actually be better off. But if it was to strengthen, it'd mean our foreign profits would return less to us. It just means you need to be aware of the fact that the world economy could grow, but then a movement in currency could eat into this growth over time. But then again, it could go the other way and benefit you. We need to revisit the weightings, as these can change our level of exposure to currency movement. Remember before I mentioned that Life Strategy 100 had an advantage of having a higher exposure to the UK? Well, here it is. Through this exposure, they actually have less of their profits come from foreign currencies, meaning it's less exposed. So you could think of it as being more stable currency-wise. So now you have all the information. Let's look at the key factors which drive the differences between each of the Magic 3. Starting with Life Strategy 100, as this has the biggest difference out of the 3. This is primarily driven by the fact that it has significantly more exposure to the UK. There isn't an issue with this, but your investment won't represent the performance of the world economy. It will likely drift quite quickly away from how the world economy is performing, meaning it will either under or overperform against the world economy over time. If we're being honest, there isn't a lot of difference between the FTSE All World and the FTSE Global All Cap. I could happily own either of these, but there are 2 differences you need to consider. The first one is cost. It's not the end of the world, but the FTSE Global All Cap does cost more, well 0.01% more to be exact. If both these funds deliver on what you're looking for, then it might be the difference to you. But it isn't all about cost. I would personally choose the FTSE Global All Cap over the Life Strategy 100, even though it's got a higher cost. But that would be due to the overexposure to the UK, which to me would be a turn-off. The last factor doesn't really have a large material impact, which is why I haven't covered it until now. The market capitalisation or the size of the companies contained in these 2 funds do vary. The FTSE All World contains only large and mid-cap companies, where the FTSE Global All Cap contains smaller caps also. But what are the pros and cons? In reality, barely any. You could argue that small caps could 100x but equally go more bust. But from a law of big numbers point of view, there's no difference. There is one part of large and mid caps that I do prefer over small caps. It's the fact that large and mid caps are generally spoken about a lot more in the media. Why is this important to me? Well, even though I have a passive strategy, I still like to know what's going on in the companies held within my ETF. That might be a factor to you, or it might not be. So there you have it. Hopefully this video has given you some insights and helps you towards a decision of which one to go for. Individuals might fiercely defend their choice over these 3, but in reality the differences don't compare to holding your money in cash. I would hold any of these in a heartbeat over holding cash. To keep to my promise as stated earlier in the video, I said I'd point you in the right direction of how to recreate these funds with lower cost funds found within Vanguard. Let's take a look. If you buy and blend the FTSE Developed All World, ticker symbol VEVE, and the FTSE Emerging Markets ETF, which is VFEM, then you'll be able to get a very similar product for a cost of about 0.16%. That's a solid 30% saving from just balancing 2 funds. You could actually go further, but you'd need to blend 5 funds. These funds would be the VUSA, the VEUR, the VJPN, the VAPX, and the VFM, which could push your ongoing cost down to 0.12%, which would be nearly half your previous cost. So why don't I do this? It does sound fantastic cutting down all this cost, but let me show you what the impact is in reality. I have around £50,000 on Vanguard at the moment, all in VWRL, and my bill for the last 3 months was only £18.20. In the grand scheme of things, it's nothing. And to me, I could save £9 every 3 months, but I'd have to juggle all those 5 around. No thanks. Imagine the time you'd have to put in to make sure it doesn't slip away from its benchmark. Couple that with the stress of having to do it yourself. If you want to do that, then all power to you, but personally, I could find a lot better and less stressful ways of making £3 a month from this. If you have made it this far, then thank you for watching. I do make other content around investing, finance and income growth, so feel free to check out some of my other videos. I do monthly updates on my Vanguard account performance, but then I also do cover other topics such as 5 inconvenient truths about investing. Anyway, thanks for watching. See you in the next one.